Great, we continue with Alexander Schlaepfer of Aster Capital. Welcome to Ecosummit.
Thank you very much. So in my case, I'm a finance guy, and that means much less pictures and no chicken, unfortunately, in my presentation. So just quickly, Aster Capital, we are a venture fund, originally corporate venture fund, funded by Schneider Electric. We have evolved. We have now several investors, still corporates and also financial institutional investors, the European Investment Fund. We invest in, the Cleantech space, even if the title of my presentation avoided the term Cleantech. I will talk about investing in the Cleantech space today. Cleantech asset class performance has been not good, or to be straight, has been bad over the last, particularly over the last, since the financial crisis. If you look at the public listed stocks, they did the red curve on top, the peak, so they did very well up to about 2008, to the financial crisis, and then collapsed. Still, along with the overall market, still for a year or two, the Cleantech sector outperformed the general stocks. But then since about 2010, the performance has been really lower than the general stocks, and only in the last probably 18 months has been picking up again. But clear underperformance towards, in comparison with the overall stock markets. In the VC portfolios, we see that even more. In the lower graph, you see the general trend in the VC portfolios from 2010 to 2012. I don't have more recent data, but so you see there, overall, the VC added about 10% per year, the value of their portfolios, while the Cleantech area stagnated. Now, what we've done what I'm going to do is really looking at what are the ingredients of investment performance, and try to reflect that on the Cleantech space, where we need to improve, and what can we do to also improve the performance of the Cleantech space. Because if we don't get the better investment performance, we will get less money. We see that already happening today. There's much less institutional capital allocated to the Cleantech space, and if the performance doesn't improve, it's not going to increase, and we will be short of capital for our investment projects. So the ingredients of investment performance that I will talk about today are essentially the valuation progression to exit. Make sure you have a steady progression and not sort of spikes and so on. Look at the target VC multiples, essentially the returns, which determines, at what valuation we will enter into a deal as VCs. The exit valuations that we can obtain in the Cleantech sector. The dilution in the process of raising further capital, the capital efficiency, and then I'll try to get to a conclusion. What we've done that was in 2012, when we were negotiating with a startup about the valuation at which we should invest. We have looked at the fundraising history of 6 biotech and biofuels deals in the US that ultimately went to IPO. So when a company files for IPO, you get, of course, the filing documents, and you can nicely read the fundraising history of that company over the years. And so we've done that. I've just taken an example here, Solazyme. We've done that for 6 deals, essentially, and looked at the trend. I mean, what was the valuation? How much money did they raise? And ultimately, at what valuation did they exit? So the IPO value. Solazyme, started off with I would say, a moderate A round, and ultimately listed at close to $1 billion market cap, or pre-money valuation was close to $1 billion. The market cap was over $1 billion. Today, Solazyme is still worth about $615 million. Some of the other companies we looked at are worth today maybe $50 million or less, or close to bankruptcy. But at least here you see, a clear exponential trend in the valuation. There is a lot of capital actually to achieve this $1 billion plus IPO. About 400 million capital was invested, so about 40% of the final valuation was actually venture money and institutional money that was poured in. looking at all those deals, as I mentioned, we then put it in relation, essentially. What was the different round? How much did it reflect of the end valuation, of the exit valuation? And the red dotted line is essentially the average, the trend. So you have, of course, the blue line. Amir is an outlier, an extreme where, you know, valuation was pushed very high early on, collapsed again, and then sort of increased again towards the end. So we set the IPO value at 100%, and so you see that the rounds, essentially the valuation increases only up to the D round, only slightly to less than 40% of the end value. And the real spike in valuation comes then, let's say, in the 2 rounds before the IPO. That is, as obviously that partly explained by the time component, essentially the, you know, the longer you hold them a stock, the more it is discounted, and that's an exponential function. And then it's also the higher value of customers that you see here clearly, and that's what I will show in the next slide, essentially. You know, what you do up to the ABC round is really you show that's the proof of concept. You show that your technology or innovation works, and that is great. But actually where the value is created is the proof of value, meaning that the technology doesn't only work, but there are people who want to buy that technology because it has value to them. And that's where the valuation is really increasing. So that's the, let's say, the valuation progression curve that we are normally looking at when we invest in companies. We look at where are we in this curve and determine then what sort of returns do we look for. And that is this curve, essentially. This looks crazy, you know, looking for 10 times returns in a seed round or 6 times returns in an A round. But I'll come back later. Dilution and so on is pressing down this, what is initially a 30% IRR, is pressing that down to much lower levels. So this is essentially the logic with which we look at the company when we determine the valuation at the time of investment. Obviously, what is then determining the valuation in dollar numbers, in absolute numbers, is what we expect the exit value to be. And so the exit is let's say, the next point I'm going to talk about, the valuations that you can achieve. And in when you sell your company or when you list it in an IPO. Now, in the transactions, and here I've taken a study from MIT on medtech industries, but it's actually a very well done study. Looked at those were M&As and IPOs. Looked at essentially the value at exit. What was the main variable that would explain the value of the exit, the valuation? And very clearly, so it's expressed in R squares, so meaning statistic correlation value to the variable. The highest correlation you find in the supernatural growth, so in the growth rate. Higher growth rate gives you higher valuation at the exit. So it's really about sales growth that is driving the exit valuation. You see also profitability. Profit margin has also a fairly good correlation, but much less than sales growth. So looking at sales growth and revenue multiples, correlate that. I've taken as an example, the software as a service business models, which are all the rage today, and where you see really high valuations, crazy valuations, 16, 18 times sales being offered for these business models. So with a 50, and there's a clear statistical correlation, as I said before, higher growth rate, higher valuation. So with a 50% growth rate, you get today in the market, first quarter, you get a 16 times multiple of your sales. That is, of course, on business models that show recurring revenues, a good visibility about the future revenues of the company. Then the other is the scalability, how capital intensive or how OpEx intensive it is to get your next dollar of revenues, your next customer, essentially. And then, yeah. Now the Cleantech sector, we've done the same with a number of stocks that we pulled out from the Baird Investment Bank's quarterly newsletter. Cleantech sector, you see the valuations are much more concentrated around 2 times sales. So there is, of course, there is a correlation, and there is an outlier up there, an 80% growing company that gets a 14 times revenue multiple. Does anyone know it? It's a US stock. It's not Tesla, no. But exactly, it's Solar City, absolutely. That's Solar City. Actually, also, you know, very similar business model. It's not software as a service, but it's actually solar as a service business model. Not extremely capital intensive, or at least they managed to essentially keep that off their balance sheet, the investments. So that is achieving a very, very high multiple, but the rest is fairly concentrated. So, and the issue is, why do we get lower valuation? So with a 50% growth, you get almost, you know, less than half the valuation in the Cleantech sector. We don't have these subscriber business models, or not many of them. Very capital intensive business models. We need to put we've set the biotech, you know, essentially 40% of your ultimate IPO value, you need to put up that capital. And so that gives you lower valuations, of course. I've just, and you will have access to the presentation, I've just tried to plot for some subsectors, you know, this sales growth, valuation, correlation. I have too few probably to make it statistically relevant. But again, you see that project developers, EPC business models, top left, there is a fairly good correlation, a strong, let's say, you know, growth rates are really rewarded well. While on for example, solar PV manufacturing, there is, you know, it's not about growth rate, it's really about capital intensiveness. It's an extremely capital intensive business, so it's just a matter of how can you finance, and ultimately you get 1.5 times your sales, your revenues as a valuation. The other point that is also playing into the investment performance is the dilution. So whenever you raise fresh capital in a future round, you dilute, of course, your previous shareholders. They have the opportunity to participate, so to minimize their dilution, but let's say their original investment is actually getting diluted. And that is, you know, if you look at this, I've taken, let's say, what I think is a normal valuation progression from whatever 5 million pre at the seed round to 100 million exit, which is, you know, I think in our industry is a good exit. Is not of course a Tesla or a Facebook exit, but you know, 100 million exit is in Europe in Cleantech industry is a good exit. So that's, you know, you would say this would be a great investment. If the A rounders invest at 5 million pre, sort of take 37% stake, that would give them theoretically a 12.5 times multiple, which would be, of course, a great investment. That would be about 55% IRR. But with the dilution, that multiple is dropping to sometime to around 5 times, which is still a good multiple, but you know, it's just the factor of dilution is pulling down your multiples and your IRR. And so for an early stage investor, A or B round, it's essentially the dilution is knocking off about 20 percentage points of your returns. And this is even more drastic in capital-intensive business models. So, you know, here we've raised 45 million over the period. So if you increase that, if the capital raised is 60 million, that dilution is even more dramatic. And that means, of course, that, you know, for any investor, if you invest in a capital-intensive business model, you will push for a very low valuation because you know you're going to get diluted much more over the time. This brings me to capital efficiency. You know, how many dollars do you need to invest to actually then ultimately get to your $100 million exit? And, you know, how much means, or saying it otherwise, how many times can the entrepreneur multiply the VC dollar that he is getting? You know, and here you see the stars, the most valuable startups currently on the planet. And what is interesting, I mean, obviously, most of them internet service business models, So not capital intensive at all, crazy valuations, high valuations, and the capital efficiency of it. You know, Uber is probably the least capital efficient. So with $1.6 billion of investment, of venture investment, they have today an 18 billion valuation. So they, you know, every VC dollar has essentially become 10 times value. But you have Zalando, for example, that did 100 times. You know, $49 million of investment became $4.9 billion of valuation ultimately. So this is capital efficiency. While we in the Cleantech sector, you know, we're looking at fundraisers where we see, yeah, we wanted 10 million euros for a pilot plant where we can prove our concept. You know, now that's not even generating customer revenue, so it's not even impacting really the valuation ultimately of your business, and it's 10 million gone. So this is very, very difficult to finance nowadays. Even 10 million in a commercial plant that only turns out 10 million of revenues in the end is very difficult to finance with venture money today, because simply you don't get the returns on that investment, right? If you're valued at one-time sales and you have to essentially invest one-time sales to get to that value, you have zero returns on it. So here, I think what is really important is to find funding for such types of projects, and of course we have them. I mean, we do need to prove the technology that we're developing, but we need to find external funding, grants, get customers to pay for it, get suppliers to pay for it, cooperate. That's the only way to finance this, not with venture money, unfortunately. So I come to my conclusions here. What I want to, you know, if this has sounded gloomy, I'm not gloomy at all about the Cleantech sector. To the contrary, I really see there are a number of important disruptions happening in our space. And disruptions are always where value is created or value is shifted from one value chain to another. So that's where investment opportunities are arising. And so, you know, new solar PV installations this year, 52 gigawatt. Even the IEA, you know, which is not sort of a green think tank at all, they acknowledge now that solar is the future, and you see here the projections, you know, fossil fuel new installations from 100 gigawatt a year going down to whatever, you know, going down steadily. Coal is phasing out, gas sort of, nuclear is still holding on for a while, they think. But clearly wind and solar are growing very, very fast over the next decades. So, I mean, I strongly believe in the PV and the renewable energy business model. On the utility side, we see a lot of disruption. Essentially, the utility business model needs to be completely reinvented. A lot of opportunity for startups there in that space. The manufacturing industry is becoming serious now in terms of energy efficiency. They are investing in energy efficiency topics. The sharing economy is transforming the mobility space. We've just heard a great presentation on what's happening in the human habitat in the cities. So there is a lot of investment opportunity, and I think we should not miss it. But we need to be more intelligent about, you know, how to develop these opportunities, and you know, part of it is really innovate where there is a demand for products. You know, it doesn't make sense to innovate a 10% more efficient ORC if organic Rankine cycles engines are not selling today, right? It makes much more sense, you know, to develop in the spaces where there is a demand, where you really solve existing problems, where customers quickly adopt your technology. The other thing is really watch the valuation. Don't push the valuation early on. Really, valuation is becoming important when you start having customer traction. That's when you can push valuation and the capital efficiency, as I mentioned before. That's it from my side.
Thank you very much, Alexander. Do we have a question for Alexander? Please raise a hand and wait for the microphone. Okay. It looks like you explained it all very well. Thank you very much.